There is completely legal way to save lakhs, sometimes even crores in taxes when you return to India. It's called RNOR status, resident but not ordinarily resident. And 90% of returning NRIs don't even know this exists. And here's what's wild. I've worked with NRIs who've paid 20, 30 lakhs in completely avoidable taxes, not because they did anything wrong, but because nobody told them about this. And I've worked with others who use this exact provision to keep most of that money in their own pocket legally. Let me tell you about one person, let's call him Rajesh. He had spent 12 years in the US, built a solid stock portfolio, some retirement savings and a rental property. When he decided to move back to India, he was excited, finally coming back home. A year later, he got his first Indian tax notice and his face went white. He owed over 25 lakhs in taxes on his foreign investments, money he thought was his, which was not earned in India. The worst part, if he had consulted a tax advisor before he moved to India, most of that could have been avoided. By the end of this video, you'll exactly understand how RNOR status works, who qualifies, and how to potentially stretch this benefit from 1 year to even 3 years. So let's get into it. First, let's understand what RNOR actually means, and more importantly, why Indian government even offers this. When you're abroad, you're classified as a non-resident Indian or NRI. India taxes only your Indian income. Your salary in Dubai, your rental income in US, your stock gains in Singapore, none of that is taxed in India. Pretty straightforward, right? But the moment you come back and become a resident again, everything changes. India starts taxing your global income. Every single rupee you earn anywhere in the world becomes taxable in India. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC and one of India's top wealth management firm before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. And I've actually seen this story play out dozens of times. Smart, successful NRIs who have worked hard abroad, built real wealth, and then lost a chunk of it to taxes they didn't need to pay, simply because they didn't know about how to plan taxes while returning to India. I don't want this to happen to you. Now imagine this scenario. You've been working in the US for 10 years. Over that time, you have built up your stock portfolio, maybe some retirement savings, perhaps even a rental property or two. If you suddenly become a regular Indian resident overnight, you would have to pay tax on all of that foreign income to India. That would be a massive sudden tax hit. This is exactly where RNOR comes into the picture. Think of it as India saying, hey, we know you have been away for a while, so we will give you a transition period. It's like a tax grace period, a cooling off period before the full tax rules kicks in. During your RNOR years, you get the best of both worlds. You are a resident for some purposes, like you can open a resident bank account, invest in mutual funds as a resident. But for taxes, your foreign incomes are not taxable in India. And if you play your cards right, this can save you an absolutely huge amount of money. So who actually gets to benefit this? Who qualifies for RNOR status? First, the baseline requirement, you need to be a resident of India. That means you must have stayed in India for 182 days or more in the financial year. Once you have crossed that threshold and become a resident, you then need to check if you qualify for RNOR status. Indian tax laws gives you 2 alternate tests. You only need to satisfy one of them. Test 1, the 9 out of 10 rule. This rule looks at your residential status over the past decade. It says that you must have been an NRI for at least 9 out of the last 10 financial years. For example, suppose you return to India in the financial year 25-26, you then look back at the 10 financial years from 2015-16 to 2024-25. If in at least 9 of those 10 years you were classified as an NRI, you pass this test. Even if you were a resident in just one of those years, that's still fine. The focus here is long-term non-residency. Test 2, the 729-day rule. This rule focuses purely on physical presence. You must have stayed in India for 729 days or less during the preceding 7 financial years. So if you're returning to India in financial year 25-26, you count the total number of days you spent in India from 2018-19 to 2024-25. If the total is 729 days or less, you qualify, and here's what makes it powerful. This test is checked every year. As long as your total days in India over the preceding 7 years stays at or below 729 days, you continue to qualify for RNOR. This is exactly how some people stretch the benefit across multiple years. Here's a simple way to remember it. One rule checks how long you were an NRI. The other rule checks how long you were physically present in India. Pass either one and RNOR status is yours. Most NRIs who have been abroad for a while easily qualify under the first option. And here's the thing, for most people, RNOR lasts just for 1 year. But with smart planning, you can actually stretch it to 2 and even actually 3 years. I'll explain exactly how in just a minute. But before that, let's talk about why RNR is such a big deal. What you can actually do with this status. Benefit number 1, foreign income is not taxed. This is the biggest one. During your RNR years, any foreign income that you don't bring to India is completely tax-free. Let me give you a real example. Suppose you hold US stocks worth $100,000 and you sell them for $30,000 capital gain. If you're a regular resident, this gain becomes taxable in India, which can go as high as 20% if it's short term, plus surcharges. And even if you assume a lower effective rate of 12.5%, that still means paying roughly $4,000 or about 4 lakhs rupees as tax in India. Now compare that to the RNR status. If you book this gain during your RNR period and keep the proceeds outside of India, the capital gains is not taxable in India at all. Same investment, same gain, completely different tax outcome. Benefit number 2, no disclosure requirements. When you become a resident and ordinary resident, India taxes you on global income. That also means full disclosure. You must report all your foreign bank accounts, overseas investments, stocks, mutual funds, properties, and every foreign income in the schedule of income tax returns. This involves tracking balances, peak values, dates, and supporting documents. Many returning NRIs find this incredibly stressful. As an RNOR, this compliance burden is significantly lighter. Since most foreign incomes and assets are outside of the India tax net, you are generally not required to disclose them in your return. So, fewer schedules, fewer disclosure, and far less documentation. RNOR status doesn't save you tax, it also saves time, effort, and lot of unnecessary compliance headaches. Benefit number 3, strategic planning window. This is where it gets really interesting. RNOR gives you time to strategically restructure your finances. Think about it. You can book capital gains on your foreign investments without Indian taxes. You can rebalance your portfolio. You can move money from low tax efficiency investments to high tax efficiency ones. You can time your remittances to India strategically. For example, let's say you're in the US and have investments in stocks there. The returns might be good. During your RNOR years, you could sell those stocks, book the gains tax-free in India as well as in the US, and reinvest in Indian mutual funds or tax-efficient Indian assets. Now let's get to the really strategic part. How do you extend your RNR from 1 year to say 2 years or even 3 years? It all comes down to one thing, day count planning. Here's how Indian tax residency works. If you stay in India for 182 days or more in a financial year, you become a resident. If you stay less than 182 days, you remain an NRI. One important exception, if your income in India exceeds 15 lakh rupees, the threshold drops to just 120 days instead of 182 days. So high earners need to be even more careful. The trick is to carefully manage your total days in India so that even after you become a resident, you keep pushing the 729 days limit as far as possible. The longer you stay below the threshold across preceding 7 years, the longer your RNR status lasts. And of course, in any year where you'll stay less than 182 days, you revert to the NRI status altogether. This isn't a hack, it's practical planning. Let me put this together with real life examples. Imagine you have been living abroad for years and never visited India during that time. Then in financial year 25-26, you decide to return permanently. You arrive in April 2025 and stay for 200 days. Because you cross the 182-day threshold, you become a resident. And since you haven't been in India at all for the preceding 7 years, your total day count is 0. That's well below 729 days. So you qualify for RNOR in year 1. Now comes the strategic part. In year 2, financial year 26-27, say you stay in India for 250 days. When you check the 729 days rule, you look back at 7 years from 2019-20 to 25-26. Your total is still only 200 days from the previous year. So you're well under 729 days. So you qualify for RNOR status again in year 2. Then in year 3, financial year 27-28, you stay in India for full year, that is 365 days. Now you check the preceding 7 years from 2020-21 to 2026-27. Your total is 200 days from 25-26 plus 250 days from 26-27. That's 450 days, still under the 729 days limit. So you qualify for RNOR in year 3 as well. However, by year 4, financial year 28-29, your cumulative stay over the preceding 7 years will exceed 729 days. At that point, RNOR status ends and you become a resident and ordinary resident. By planning your days like this, some people are able to extract 3 full years of RNOR benefits, although this requires very precise planning and clean travel records. That said, this strategy only works if your day counts are airtight. You need to track every single day meticulously using spreadsheets, passport stamps, boarding passes, and travel histories. Remember, both the day of arrival and the day of departure are usually counted as days in India, which is where many people slip up. Travel planning becomes extremely critical. That long international vacation can make all the difference. Most importantly, never do this casually. Sit with a competent chart accountant before returning to India, review past years, project future travel, and document everything properly. RNOR planning is powerful, but only when executed with discipline and proof. And here's the pro tip. The financial year runs from April 1st to March 31st. So, if you're returning to India, consider timing your return strategically. I hope you're actually taking notes, because what I'm about to share next is where real money is actually made or lost. Also, if you made it this far, you're serious about this, hit the like button and subscribe so you don't miss the next one. These are actual investment strategies you should execute during your RNR years. Strategy 1. Book capital gains strategically. If you hold overseas investments that have appreciated significantly, your RNOR years are the most tax efficient time to exit them. You can sell those assets, park money overseas, and avoid Indian capital gains tax altogether. Later, when you actually need the funds in India, you can remit the money without being taxed again on original capital gain. Only the new income generated after remittance, like your interest, dividend, or reinvestment capital gains, are become taxable in India. Strategy 2. Rebalance your portfolio. RNOR status gives you a clean window to move from a tax inefficient to a tax efficient investments without triggering Indian taxes. Strategy 3. Use gift cities to reduce TDS friction. Many returning NRIs face one major irritation: TDS. The tax deducted at source stays even when the final tax liability is lower or nil. Now, if you haven't heard of Gift City before, here's a quick explanation. Gift City is India's international financial services center located in Gujarat. It's designed to bring offshore financial activities back to India, and it comes with several tax advantages. Gift City solves the TDS problem elegantly. By investing through Gift City feeder funds, you get Indian mutual funds exposure with zero TDS and USD denominated investments. While this is very brief, if you want a detailed explanation, you can watch my video on this topic. I'll put a link in the screen. Strategy 4. Time your remittances carefully. This one's actually critical, and it's where I've seen people lose the money most. Let me tell you about another person I've worked with. Let's call her Priya. Priya did everything right. She had been in Singapore for 8 years. She understood RNOR. She even hired a CA. But she made one critical mistake. In October of her first RNOR year, she sold her Singapore stocks and booked a massive gain around 40 lakh rupees. Tax-free under RNOR, right? Yes, but she received all of her proceeds in India immediately as she got excited about a real estate opportunity in Mumbai. She needed the money fast. The single transfer made her entire capital gains taxable in India. She ended up paying over 5 lakhs in taxes. 5 lakhs gone because of this impatience. The rule is very simple. Foreign income remains tax-free during RNOR only if it stays outside of India. If you sell foreign assets and do not receive the proceeds in India and hold it in an overseas account and maybe remit that money to India later years, or better yet, until you actually need the money in India. Please don't be Priya. You need to plan this properly, otherwise you can unnecessarily be taxed in India. Now let me quickly cover the other mistake I see all the time: not tracking days properly. Many people return to India casually, assuming things will work out without mapping their travel for next 2 to 3 years. Plan your calendar early, mark family events, work travel, and long international trips. Then see how your India stay can be optimized. Assuming RNOR status happens automatically. It doesn't. You must explicitly claim RNOR in your tax return, and your chartered accountant needs to be aware of this from day one. Thinking foreign income doesn't need documentation. Just because it's not disclosed doesn't mean it shouldn't be documented. Maintain clean records of overseas incomes and asset sales. You need to explain the source when you eventually remit funds. Believing RNOR means zero tax. It doesn't. Indian income such as rent, salary, and interest remains fully taxable. Trying to do all of this without professional help. RNOR planning is not DIY territory. Spending 10,000 to say even 20,000 rupees on a good CA who actually understands NRI taxation can easily save you lakhs in avoidable taxes. So what's the action plan you can actually use? Before you return to India, consult with a CA specializing in NRI taxation, ideally 6 months before you return to India, if not earlier. Calculate whether you qualify for RNOR under the 9 out of 10 rule or 729 days rule. Review all foreign investments and identify capital gains opportunity. Plan your day count for the next 3 financial years. Create a spreadsheet to tag days in India versus abroad and research gift city investment options if relevant. During your first RNOR year, file your income tax return claiming RNOR status. Very, very important. Execute your capital gains booking strategy. Don't remit foreign incomes to India. Set up tax efficient investment structures and keep meticulous records of all foreign incomes and assets. So here's where we are. RNOR is one of the most powerful tax advantages available to returning NRIs, yet it remains massively underutilized, not because it's complicated, but because most people don't even know about it. Remember Rajesh from the beginning and Priya? Both lost lakhs in taxes. These aren't hypothetical examples, these are real people who made real mistakes. And every year, thousands of NRIs make the same exact ones. But you don't have to, because you know what RNOR is, you know how to qualify and how to maximize it, and you know exactly what mistakes to avoid. The one question is, will you act on it? If you're considering a move back to India in the next few years, start the conversation with a tax advisor now, not when you've booked your flight tickets, not when you've landed, now. Because the difference between the NRIs who keep their wealth and the ones who lose chunks of it to unnecessary taxes isn't intelligence, it isn't even luck, it's simply this: they got the right advice at the right time. Do drop a comment below if you have any questions about RNOR. I read every single one of it and I'll try to answer as many as I can. That's it from me. I'm Nikhil. Let's make your finances less tricky. Thank you for watching and I'll see you in the next one.